Welcome to Market Catalyst. I'm Julie Hyman, broadcasting from a snowy New Jersey today. And we are watching markets today ahead of a very, very busy trading week of various events, from the Federal Reserve's meeting, at which it's not expected to change rates, to earnings from 4 of the 7 Magnificent 7 stocks, and earnings from many, many more companies as well. It's really expected to ramp up on Tuesday in terms of the earnings reports after a quiet Monday, by the way, in which we are still watching the after effects of a big winter storm that hit 17 states within the U.S., as well as other events over the weekend that could affect what's going on in Washington. So right now we are seeing the Dow rise by about almost 140 points, the S&P gaining about 0.4%, and the NASDAQ gaining 0.4%. Now, among the many, many companies that are reporting earnings this week will be Apple. It's due to report its numbers after the close on Thursday. The shares down this year around 7% after rising about 8.5% last year. And there are a lot of questions about not just Apple's iPhone sales, but what happens with artificial intelligence. To talk about all of that and talk about what to expect, let's bring in Brandon Nisbell, KeyBanc Capital Markets Equity Research Analyst. Brandon, thanks for being here. When we're looking at kind of the setup into Apple's earnings, does it feel like because this stock has been languishing a little bit, that the bar is lower, or do you think it still has a lot of work to do to convince investors?
Like you said, the stock's underperformed. It's underperformed year to date. It underperformed last year, but expectations are actually reasonably high. We do think the setup is reasonable. We're in line with consensus. Consensus is looking for, iPhone growth of almost 14%. It's one of Apple's strongest growth quarters that we've had. One of the things that we're more concerned about, though, is what the guidance looks like, especially as we're looking out in the second half of the year. And, the other thing that I think people are focused in on is just the rising component costs, things such as memory prices that keep going up pretty much on a daily basis.
So do you expect then the margins to be affected? I mean, Apple's kind of known for some pretty healthy margins.
Definitely in the second half of the year, Apple's probably going to be in a position where they're going to need to take a price increase on the iPhone, where I think people are concerned about the impact that could have on demand. And if they don't take a price increase on the iPhone, I think you'd have more concerns about margins to that point.
Gotcha. Interesting. So we'll watch for that potential price increase. In terms of the backward-looking quarter, Apple rolled out the new iPhone Air, and there's been some chatter that people weren't too excited about that one. I'm curious how you think it's going to do and how that's going to show up in the numbers.
Yeah, from our perspective, the Air is not selling well. That's not going to be the driver for the quarter. What we really see is the driver for the quarter, and you're going to have pretty strong unit sales for Apple, but the driver for the quarter is going to be what it's been for the last couple of years, really strong Pro and Pro Max sales. And what that's going to mean for Apple is stronger mix towards higher average selling prices. And so you'll see ASPs up along with unit sales, but the Air was not necessarily a driver for the quarter at all.
Gotcha. Let's also talk about some of the other overhangs for the company that maybe we'll get some updates on, right? And some of that has to do with Siri, has to do with AI, and now the company is partnering with Google. What questions do you have for them around how that's all going to work?
Yeah, I think, the key question for us is how is Apple going to monetize AI? They're also utilizing a competitor's technology. So I think those are really key questions. When Apple initially announced Apple Intelligence, a lot of the promises that they told us they would come out with were not there. And then they delayed the rollout. So what we'll really be listening for are what key integrations are coming. I think what people want to see is deep integration with Siri, with other applications that you can use on your iPhone. That's really the key question. And then beyond that, one of the things that we were excited about last year is whether or not AI will drive a hardware upgrade cycle, get people that have older devices to really want to upgrade their phone. That's really the key question. So, can they integrate this technology, whether or not it's theirs, doesn't really matter as long as it can drive some type of hardware cycle. Those would really be the key focus items.
Well, and that kind of brings up the question I've had about the AI integration to the phone, which is whether it's a push or a pull. In other words, like, is this something that users want? Many of them are probably already using ChatGPT or Claude or what have you on the phone. So, is it just a matter of that Apple has to have it to drive that upgrade cycle that you're talking about?
Well, again, that's the question: is how deeply can Apple integrate Gemini into Siri, where Siri can then control the different applications on your phone, where Siri could then go book a flight for you or schedule a restaurant reservation for you without you having to actually do anything. That's the key question of how deeply Apple can integrate it. And then whether or not they can actually monetize it. Some of the research that we've done, consumer surveys, really suggests that consumers are not interested in paying for something like that, but that would just deepen Apple's integration into consumers' lives, and I think make their technology more indispensable. So I think consumers would end up using that, but the key for Apple, I guess, again, would be keeping people within their ecosystem, utilizing their products, and ultimately they'd sell more smartphones.
And Brandon, you've got a sector weight rating here, hold equivalent rating. What would you be looking from them to change your mind on that?
I think we'd want to see, expectations in terms of where growth expectations are really come down. From our perspective, growth expectations for iPhone are really like up and to the right for the next couple of years. That's pretty lofty expectations for a company that is in a much more mature business and generally more cyclical. So we'd want to see expectations come down and or the valuation move lower. Apple's not inexpensive. It trades at roughly 22 times EBITDA. That's higher than it's been historically. So we'd want to be picking up the stock when expectations are much lower and or the stock is trading at below its historical average.
Brandon, thanks a lot. Appreciate it.
Thanks, Julie.
Coming up next, the events over the weekend in Minneapolis have potentially raised the odds of a government shutdown. We'll talk about that and the potential economic impact next. Odds of another government shutdown have been rising, with Polymarket showing those odds at about 80% as of this morning. Now, odds had been, as you can see from that, have been greatly diminished until the events of this weekend and the killing of Alex Pretti in Minneapolis. Our Ben Werschkul, our Washington correspondent, is joining us now with more details on this. So it seemed like we were going to avoid another one of these until what happened this weekend.
Absolutely. Yeah. What the events of this weekend has clearly kind of changed the political calculus here. I agree with you. Last week, we were kind of dismissing the chances of government shutdown. Now it's very much likely, because the bill on the floor this week that the Senate is considering has the Department of Homeland Security funding in it. The Department of Homeland Security is the agency that oversees ICE as well as the Customs and Border Control. So that's the real issue. Chuck Schumer has said Democrats are not going to support it, and a unified Democratic Party can block it unless there's an overhaul of the agency. So that's a major sticking point that's clearly going to be pushed very hard from both sides on this issue. In terms of what a government shutdown would look like, we are in a different place than we were over the last government shutdown, because what would happen this Friday, if there is gridlock through the whole week, is what's called a partial government shutdown. There's 12 appropriations bill that need to pass Congress to fully fund the government. 6 are actually already done and dusted. So they're already set. Those agencies are going to continue no matter what. It's these other 6, the Department of Homeland Security and 5 others. So that's going to lead to kind of mixed economic effects if this goes forward. Government economic data is a big one people watch. The Department of Labor, that oversees the monthly jobs report and things like that. They may shut down. The Department of Commerce, which oversees other economic data, has their funding set and will not shut down. Similarly, the SNAP program, which was a big issue in the last government shutdown, is fully funded until September. So that would continue, food benefits, things like that. Airports, on the other hand, those agencies are up in the air. They would be shut down and would have some potential delays there at the airports from TSA agents and air traffic controllers. So a lot of mixed signals. Washington seems very gridlocked at the moment, and I would agree chances are high. But what this looks like is still being sorted out.
Gotcha. And a lot more complicated this time, it sounds like, in terms of what shuts and what doesn't. Meanwhile, speaking of economic impacts, we're also watching Minneapolis for that reason, because of what's been going on there. And we now have a number of CEOs, a lot of big companies actually based in Minneapolis, and a number of CEOs have signed on to a letter kind of calling for basically things to stop happening. But I guess that too is more complicated.
Absolutely. Yeah. So this is a significant letter, and this is 60 CEOs, and the major names are based in Minnesota and Minneapolis, Target, 3M, companies like that. The language here is pretty limited, I would say. It talks about calling for an immediate de-escalation of tensions and for everyone to work together to find solutions. That's pretty vague. Clearly, they had to kind of negotiate amongst all these CEOs to get language that would be agreed upon. So the effects of that could be pretty limited in terms of the situation on the ground and the immediate question of whether ICE will stay in Minneapolis for the foreseeable future. What it reminded me of, just to tie it to the government shutdown point, is this is very similar statements you're seeing from Senate Republicans at the moment. Essentially, we're unhappy with this. There's a problem here with what's going on in Minneapolis, but we're not calling for anything concrete, especially calling for ICE to leave the state at the moment. So if either of these front shifts, Senate Republicans or CEO leaders like that would be significant and would increase the pressure on the Trump administration to make a real concrete change of what's going on there. But at the moment, they're clearly holding back kind of the amount they could go further.
And then while I have you, Ben, and as you're covering everything that's going on in DC, you're very busy, obviously, by the way, with that. Last week we were talking about Greenland. Now we're talking again about Canada, because after a speech by Mark Carney last week and after some discussions between Canada and China, President Trump is once again threatening some new tariffs on Canada.
Exactly. Yeah. Another weekend tariff threat from the president. I will say that this Canada threat, what we're seeing from the president, the sense I'm getting here in Washington is that it's being downplayed a little bit, partly because there's so many off ramps that are just in evidence here of sort of how this could end. What Trump is threatening is 100% tariffs on Canada over its relationship with China. He's claiming that China is taking over Canada, and he can't stand for that. So he's going to sort of essentially institute 100% tariffs there. What I think is key here is that his threat here is about, when you read his post, it's kind of about a future deal that even Mark Carney says is not in the offing. What China and Canada did do a few weeks back was a kind of limited deal on canola oil EVs and things like that, which is significant to see these two countries cooperating. But this is not a free trade deal. Mark Carney has said that's not going to happen anytime soon. Trump is clearly trying to preempt any moves in that direction. The overall music here is the USMCA is up for renegotiations this summer. So a lot of this back and forth is clearly kind of setting the stage for that. So we're going to see a lot more of this in the months ahead. I think, although the sense, I think for market short term is there's a major change here in the next few weeks, although the US-Canada relationship is very clearly up in the air in the year ahead.
Yeah, should be lots more for you to talk about, Ben. Thank you very much. Appreciate it.
Thanks much.
Well, let's talk more about the economic implications of another potential partial government shutdown, as well as look ahead to the Federal Reserve meeting this week. For that, we bring in Stephen Junot, BofA Securities Senior U.S. Economist. Stephen, thanks for being here. I just want to touch on the potential for a shutdown, first of all. As we just heard from our Ben Werschkul, this one, unlike the one that we saw late last year, because it's a partial shutdown, but still, are you now starting to handicap a potential economic effect from that?
Yeah, so I think being partial, it makes a big difference. Obviously, there's still a lot of big agencies left to be funded, but the drag coming from kind of the economic calculation, the furlough of workers, would be more modest than what we saw in the fourth quarter were this to occur. And I think, more importantly, from my seat where I am as an economist, what I'm most worried about is probably the data, because we're still recovering from some of this missing data. So not having the Bureau of Labor Statistics be able to publish employment data, inflation data, while they're still kind of catching up to the effects of the previous shutdown. Well, I think that will cause more of a disruption, both to markets, but also for economists, for the Fed, for policymakers as well. So I think that's a big risk, and we'll have to see how things play out this week when it comes to the votes.
Stephen, I'm curious also, because I'm home in New Jersey today broadcasting because the Jersey Transit was not running today. I'm curious, when you see a big storm, the scope of which we haven't seen for quite some time, how much of an impact does that have on economic growth? Or is it something that's sort of just like it was with the shutdown, maybe a little bit delayed or displaced?
Well, that's a great question. And I'm in the office, as you can see today. So at least some of us have been able to make it in, but, we're all kind of fighting the weather. I'm one of four, I think, here in this office, so not many. And we actually were able to look at a previous storm in 2021 and see how that affected consumer spending, both our data and the official data. And you do see that these major storms can be a drag, and they tend to get made up in subsequent quarters because that spending is going to happen at some point or the other. But there is some loss activity, right? You're going to have some flights that are canceled that don't come back online. You'll have stores that are shut for the day, and maybe they're not making up that business, so to speak. So there is some loss of activity. It's relatively modest, I think, in terms of net loss, but you could see a drag in the first quarter and then maybe a boost in 2Q as you get kind of that mechanical rebound, similar to the shutdown.
Gotcha. Only 4 people in the office. Wow. I guess you got a lot of commuters there at BofA also. Let's talk about the Federal Reserve meeting this week. We all are assuming there's not going to be any change to rates. So if that's the case, what are you really going to be focusing on here? Is it going to be sort of the political questions that Jay Powell is likely to get during the presser? Is it going to be dissent? What do you think?
Yeah, I think of the things, obviously we're going to be parsing the statement as we always do. We'll be parsing the presser. I think you make a good point in saying that the presser is probably going to revolve around political questions and not necessarily forward guidance. So we won't get too much from that this time, but I do think dissents will matter because you're going to start to see, how are things positioned on the committee heading into the post-Powell Fed. When we get a new Fed chair, and that could happen any week now. Obviously, we've seen betting markets move around about who people expect to be the next Fed chair. But we'll see with dissents, is the committee still biased towards cutting? Is that still that firm camp? Obviously, Governor Myron is very likely to dissent. But then what about the hawks? Because there are several hawks on the committee who probably weren't too on board with cutting rates in December. And maybe they use this opportunity to maybe issue a dissent too. So I think you're looking at dissents, you're looking probably at the minutes in 3 weeks for really where the debate is, where the consensus is, how dispersed are the views on the committee. So we may not get that much information today, but maybe the dissents will give us some information. Maybe we'll learn more in 3 weeks from now when we get the minutes, though.
And as you mentioned, we might be getting an announcement of the next Fed chair this week. And, the odds markets have just swung wildly with Rick Rieder now on top. He was somebody that a lot of people had sort of discounted entirely for much of this discussion. I mean, at this point, how important is it which of these individuals it's going to be? I mean, is the outlook for rates going to move that much depending on who it is?
I think the short answer is probably not. They're probably all supported of cutting rates more than maybe the current Fed led by Powell is, and cutting rates, relatively quickly to say a 3% level. So you've heard that from Kevin Hassett, you've heard it from Kevin Warsh, you've heard it from Rick Rieder, even from Governor Waller, right, who's still kind of in the running. So I don't think in terms of the general dynamic, it doesn't change all that much in terms of direction of policy. Where you could see some differences emerge is maybe on reforming the Fed, on regulatory policy, on balance sheet policy. It's some more nuances, but I think the path for rates between the four of these candidates is not looking all that different. And then what I'll stress as well is they're just one vote. And, the composition of the Fed may not change all that much other than getting a new Fed chair. So it's really going to depend on what the committee's read of the economic conditions is, and how do you get a majority view in terms of setting policy rates. And that's really going to always come down to economic fundamentals, economic activity, inflation, the labor market. So we'll have to see how things play out this year.
We will. Stephen, thanks a lot. Appreciate it.
Thanks.
Coming up next, we look ahead to Tesla earnings. Stay tuned. Both Tesla and GM report their numbers this week. Tesla shares falling today ahead of those numbers. A lot riding not just on what Tesla reports, but what happens for the company this year. To talk more about that, let's bring in Garrett Nelson, CFRA analyst. He has a sell equivalent rating on those Tesla shares. Garrett, good to see you.
Sure. Thanks for having me.
So it feels like there's a lot riding, maybe not just on these numbers, but on Tesla execution generally. I mean, the shares have doubled since last April, but they've kind of gone sideways. They kind of tread water since September. So what, in your view, would sort of move the needle more substantially in terms of these numbers?
Yeah, in our view, it's all about risk reward. And given the run up that the stock had really since last April, caused us to go to a sell last fall. We just felt like the risk reward was no longer favorable and in fact unfavorable. So our current price target is $350. If you look back over the last several quarters, Tesla has not had a very good earnings track record. In fact, they've missed on the bottom line in 7 of the past 9 quarters. So I think what you're seeing with the shares, both today and leading up to this release last week, ahead on Wednesday, is there's really a lot of caution. We know Tesla's earnings were down 31% year over year in the first 3 quarters of last year, and now they're getting ready to report the fourth quarter, the first quarter in which the U.S. EV market was no longer subsidized by federal EV tax credits. So we're expecting a more substantial year-over-year drop in earnings. If you look at consensus, they're expecting earnings to be down 38% year-over-year. And, we think that earnings, really this earnings malaise is going to carry over into 2026, which is our primary concern. It's just the disconnect between what the stock price has done over the last several months and the earnings trajectory that we see in the coming quarters.
So, and in your view, is that elimination of those tax credits sort of twofold? On the one hand, maybe reduced demand for Tesla vehicles. On the other hand, they sold those tax credits, right? Or and that was a source of revenue for them too. So what sort of combined effect, how should we be looking at that?
Sure. So we know exactly what Tesla's vehicle sales were in the fourth quarter. They reported that in early January, and their sales were down 16% year over year. But our bigger concern with Tesla is just the sale of these regulatory emissions credits under CAFE standards of the U.S. government, and that's been a very fast-growing, high-margin revenue stream for the company in recent years. And essentially, that market largely went away overnight with the signing of the One Big Beautiful Bill Act, because CAFE standards were no longer enforced. And so these emissions credits, which Tesla would sell to other automakers which didn't have as much EV exposure, was a very profitable source of revenue and earnings for the company. And so that largely will go away. And that's going to really affect Tesla's bottom line, in our opinion. So, and then, you look at 2026, and this is a year where Tesla really has a lot to prove from an execution standpoint. They've promised volume production of the Cybercab, the Semi, and the Megapack 3 this year. And so, it's a big year from an execution standpoint. And we think, the management really has a lot to prove here.
And on that front, what is your outlook for robo-taxis? I think Morgan Stanley sees 1,000 of them on the road by the end of this year. Is that reasonable?
Our outlook is it's a very impressive technology, but that the rollout is going to be a lot slower than what management is forecasting to. Already, since they went live in Austin in June of last year, the rollout has been much slower than what they had promised. So we think that will continue. Even last week, when they announced that they've gone fully unsupervised in Austin, it turns out that the Tesla vehicles were being followed with other Tesla vehicles, which did have a driver. So that wasn't really true, and we just think the rollout to other markets is going to be a lot slower than expected. Based on our channel checks in other states like Nevada, they're well behind in terms of filing the necessary paperwork, in terms of getting permitting. And so we think it's going to be much slower than what they're expecting, which is a big risk.
So we spent all of our time talking about Tesla, not surprisingly. I got to ask you a question about GM, though, too, because it reports tomorrow morning. There you have a hold equivalent rating. And, it feels like both Ford and GM have really been struggling to just correct their trajectories right now. So what does GM need to do? How do they need to deliver?
Well, GM has had a great run. You look back, they've beat on the bottom line for 13 straight quarters. The stock was the best performing auto manufacturer last year. GM shares were up 54%. Compare that to Tesla, which Tesla shares were up only 11% last year. So it's had a great run. This was one of our top picks in 2025, and we just went to a hold on valuation in mid-December. And so many things have gone right for GM. They've grown their market share in the U.S. significantly over the last 3 to 4 years. But really, it's their large EV exposure which gives us some pause here, and was really the reason why we head to the sideline. They've become the second largest company seller of EVs in the United States in recent years. And we've seen where they've already taken some write-downs related to their significant EV assets and investments that they've made. And while EVs have been a major growth driver for the company in recent years, we think there's going to be a reversal of that, where they're actually going to lose some market share this year, due to the EV tax credit expiring. So we're a little more cautious. And again, it was a risk reward call. The stock had a big run up, and we just no longer saw a favorable risk reward, a risk reward that really appears more balanced here in our view.
Garrett, thanks. Appreciate it. Good to see you.
Thanks for having me.
Keep it right here on Market Catalyst. We'll be right back.
Health insurers are back in the political spotlight, with Congress grilling executives on Capitol Hill over rising premiums, denied care, and executive pay. For more, bringing in now Kim Monk, founding partner at Capital Alpha Partners. Kim, it is good to see you. So I guess first thought, Kim, just get your take on that hearing on Capitol Hill. CEOs are up there, these big insurers, they're getting grilled. Kim, you were watching. I mean, what did you make of it? What did you learn? Was it just theater, Kim, or no? You see real policy change coming?
Yeah, it was a long day for those CEOs. They had two very long back-to-back hearings where they had to field a lot of questions. On the one hand, it was what you would expect, Democrats staying on message, blaming Republicans for letting the enhanced ACA subsidy expire, and Republicans talking about how the ACA is unsustainable and Democrats built that system and we can't keep putting more money into it. I would say that it was surprisingly substantive in terms of the questions. A lot of discussions around cost drivers, underlying cost drivers. Some would say the insurers deflected, blamed hospitals and drug costs. Some talk of MLR, that's the medical loss ratio, and how the insurers are required by law to pay a certain amount for healthcare, 80 or 85%, and they're capped in terms of what they can have for margin and admin and marketing and things like that. But I think the other thing we saw was, from both sides of the aisle was some agreement over concerns about these big vertically integrated companies, about how that impacts consumers, about the PBM model, and particularly the overseas group purchasing organizations, CEO salaries. So it's a little bit weird because we're seeing this sort of populism where the right and left are coming together around some of these issues, and we even saw some Democrats defending the health insurers. So that was a little bit of a change from the past years.
You know who was also watching and listening clearly, Kim? Mark Cuban. I don't know if you saw this. Here's what Mr. Cuban posts on X. And when he posts, he gets attention. He says, "Too big to care. Make them divest all non-insurance assets." What do you make of that? Is Cuban right? I mean, could you ever envision that happening? And if it did happen, Kim, how would that happen from a policy perspective?
Yes, so I do follow Mark Cuban on Twitter, and he posts something like that every other day. He's very active. And he's not alone in saying that. Obviously, he has a vested interest himself because he has his own DTC platform, Mark Cuban Cost Plus Drugs. So he does have a financial interest as well. But other people are starting to talk about this. But, I think it's very challenging to go from we're concerned about this vertical consolidation to breaking up the companies. There is a bill that's been introduced by Senator Liz Warren and Josh Hawley, a Republican from Missouri, that would require the insurers to divest their pharmacies. That's not really gone anywhere. I don't think they've attracted many co-sponsors, but maybe it gains traction if the left and right are saying something's got to give here. I've never seen Congress step in and break up big companies, though. I think that that's something that's difficult to do. And if you look ahead for the rest of 2026, I don't see a lot of legislating going on. We've got very tight margins on the Hill and a midterm election coming up, and Congress is probably going to finish this round of spending bills and be done. So the other avenue here might be, DOJ or FTC, sort of antitrust. That's not so easy either. FTC has been looking at PBMs. They do have some litigation around the PBMs and their insulin prices. But if you take a page from what's happened in big tech, they've been working for decades on antitrust issues there, and they really haven't had much success. So even if Trump sort of steps in and says, I want FTC, DOJ to start looking at these, big PBMs, vertically integrated companies, we're talking many years down the line. And even then, all these deals were approved by regulators at some point in the past.
You mentioned Trump stepping in, Kim, and the president has said he wants to meet with health insurance CEOs, wants to negotiate price discounts, like he's done with drug companies. How do you see that potentially playing out?
Yeah, well, they're having a hard time even scheduling it. Trump has been talking about this since before the holidays. Of course, he's been busy with international affairs and other issues. So we'll see if and when this pans out. I don't see it playing out in a very positive manner for the health insurers. The comparison here really is, the pharmaceutical industry and all the deals the White House has made with the 16, large drug manufacturers. The reality is the White House, the administration just doesn't have the same regulatory levers when it comes to health insurance. There are different markets. Obviously, health insurance is largely a domestic business, so you don't have the threat of tariffs, which has been a big lever for the pharmaceutical deals. You don't have the regulatory framework that you have with pharma, which are, IRA drug negotiations and some of those levers. So I suspect Trump will get fairly frustrated and potentially even bored if the insurers start talking about, hey, guess what? Our margins are already capped with MLR, and hey, our rates have to be actuarially sound. And at the end of the day, if costs go up, that will be reflected in the premium. So I don't see it necessarily producing, deals like we saw with pharma. And I guess the question would be, what next? Does Trump get frustrated? Does he order, HHS and CMS to take some sort of action? And then you have to think about, well, what levers does the government actually have when it comes to health insurance?
Final question, Kim. I know we were, kind of watching lawmakers, rain down fire on these CEOs and these big insurance companies. How do, just actual Americans, everyday consumers, feel about their healthcare plans? What does the polling say there? Do we have line of sight, or are most people as frustrated?
Yeah, I think so. Historically, the view is health insurance is terrible. Health insurers are terrible, but I like mine. I think we've seen that change. I saw some polling recently that suggested it's sort of crossed the midpoint, the 50% point of people who think the system is broken. And I think consumers are frustrated because they feel like they're paying more and more into the system, whether it's in premiums or higher and higher deductibles. And they're wondering what are they getting out of it? Because a lot of consumers are, facing delays, prior authorization, red tape, lack of transparency. So, yeah, I don't know that we've reached a breaking point. But yes, there's definitely growing frustration. And I think just because the system is so complex, it's public, it's private. We have, private sector employers involved. It's really complex. So I think the lack of transparency and around how the whole system works is kind of frustrating for consumers, but also increasingly for regulators.
Kim, so great to have you on the show today. Appreciate your time. Thank you.
Sure.
Elon Musk saying last week in Davos that he expects to be selling Optimus robots by the end of 2027. Of course, those are humanoid robots, and we seem to be entering this sort of hype cycle for robotics. So let's get it down to reality and talk about what is happening actually now in terms of the robotics space. We're joined by Jake Lucasarian, Gecko Robotics CEO. The company makes robots, but not humanoid ones, Jake. And so I wanted to catch up with you because we have had all of this talk about humanoids, and yet most of what's happening actually concretely in the industry right now is making robots that don't look like humans. So talk to us about what you guys are working on these days and kind of how you're thinking about that sort of public hype cycle around humanoids.
Yeah, thanks for having me on. I was out there in Davos hearing so much about the excitement about robotics. I think what's interesting is, when you get down to the hype of AI and artificial intelligence, what you begin to realize is you interrogate the information, data sets, and actions that go on, especially in these like physical worlds and sectors, and you realize that there's actually a fair amount missing as it relates to the infrastructure that can power such the gains in the ROI for AI. And so a lot of the CEOs that I talked to in the energy, manufacturing, and then the folks in decision makers in the military, they're very much interrogating, okay, where's all the information, data, and gains and ROI that we been promised. And so this is why there's such a boom and a focus on robots, is because they help to fill this huge data gap and an action gap that exists in the real world where ROI is created.
And so, when people, and we're showing some of the footage of Gecko's robots, and And so what you're talking about is less like a robot that will do things for you, although there is some of that, and more of a data gathering device, to your point, sort of being able to map in AI what exists in the physical world, right?
Yeah, that's right. I think one of the things to really drive home the point of, look, I started this company 13 years ago before robots and all the sectors that we're talking about were cool and kosher to talk about, especially from Silicon Valley. And so what we began to realize back 13 years ago was that the information, the actions, the things that in the real world that can really drive transformational change for businesses is actually focusing on the business outcomes, whether it's creating kilowatts, refining petroleum or hydrocarbons, or it's getting ships out of dry dock faster to deter conflict around the world. And so this is the thing that we wanted to focus and wanted to create a vision for robotics to be able to pave the way to create these incredible gains and change the way that these businesses can actually run, decisions they can actually create and make, and actually do it as well safer and an environment that allows for you to get the most ROI possible, with both these droids that you see here and then also the humanoids that are coming. But the thing that's missing and has been missing has been a universe and a platform software-wise where all the information and data can go. And that's why we had to make Cantilever, which is what we sell to our customers.
Gotcha. In addition to the robots that are gathering the info. Now, are you guys developing a humanoid as well? Or is it a matter of that when humanoids get developed, they'll be able to, sort of upload the data they collect into your system?
We are creating the infrastructure and the nervous system for those humanoids to be able to actually be as impactful as possible. I mean, what's so cool and so interesting when we see these humanoids, we see ourselves in them, right? We're like, we're creating these generalized robots that we want to be able to take on some of the tasks that we don't like to do, folding laundry or making food or cleaning dishes. What we don't talk about is there actually a ROI to that? Am I going to spend a bunch of money, to be able to have a robot do that? And the reality is most likely not. And so the question is actually, how do you employ robotics to actually drive massive amounts of ROI? And you have to create a structure, a platform where all the information data sets, for robots can go to. And the most ROI you can create is actually in the sectors that I was mentioning, like the energy sector, the Department of War, these manufacturing sectors, these 30 jobs that actually drive GDP. And so, that's what the robots that we focus on building are oriented towards. And then we kind of want to see the value that humanoids and mobile robots can bring, because I can tell you something, it's, there's not as much value, these like walking and these walking around robots aren't exactly the most impactful as it relates to changing the way that these companies and these sectors operate and work. They will. But the key is to focus on the kinds of tasks, the kinds of information that can drive the kinds of decisions that weren't possible before and can actually have high ROI. Everybody's focusing on this question right now because they have to be able to justify all this investment into infrastructure and technology. And they know that this will be the differentiator, for these companies in the next 5 or 10 years. It's going to completely upend, who is the dominant players. Like in the Middle East, for example, I was just there for ADIPAC and UAE and Abu Dhabi, and I got to see firsthand, some of the aggressive moves that CEOs like Dr. Sultan Al Jaber is taking, because of the core belief that this will fundamentally change the chessboard as it relates to the global economy. And so, those that adopt quickly are going to dominate the next 5 or 10 years.
Jake, before I let you go, I have to ask, because you guys are private, if there is any update on an IPO for you all or how you're thinking about that.
Yeah, the IPO will be. What's exciting is that as the acceleration, there's so much tailwind in the robotics and energy sectors right now, it's beginning to get more and more tempting to do so earlier. But I won't comment on that right now. We're really focused on delivering all this impact, and because of the technology gains and the adoption from our customers, my goodness, there's a mad rush to hire a bunch of people right now and just deliver incredible 8-9 figure results for these customers. And so that scaling that is what I'm focused on right now.
Jake, good to catch up with you, and we'll stay tuned on that front. Appreciate it.
All right, you too. Thank you.
Take care. That does it for Market Catalyst. Keep it right here on Yahoo Finance.